Hey everyone, in this video I want to go over the topic of when to cut a loss. So let's suppose that you were looking at PayPal on this day and the market starts and you can see the stock is going up at the open. This is on a 1 minute chart, so we've got a few bars that go strongly positive. You can see that the VWAP is going up, the weighted moving average is going up. You can see the stock is at the top of the channel. Everything looks fine. It's moving away from the YCTO, the price range between the previous day's close and today's open, and you decide to do a bullish trade. Well, then after you do that trade, then let's say that the following starts to happen. Now the stock starts to slow down. Nothing looks bad so far. It just looks like a modest pullback, something that's normal. But then after that, this happens. Now what do you do? Well, for some people, they would stay in the trade and basically hope it goes higher, or they would start adding to their position, but you don't want to do that. Basically, whenever this happens, where you suddenly see the stock change direction to move towards the other side of this VWAP channel, where it's basically trading below the weighted moving average, it's going back to the VWAP. In fact, right after this, it actually trades below it. So at the earliest, this would be your clue to absolutely get out, but this will be your latest clue that it's time to go because you can see the stock is shifting over to the other side of the channel. If this were a really good trend, this would not happen. Now, it's always possible that the stock could keep going up after that. It could turn around and go right back up. I've seen that happen many, many times. But we don't want to make our decisions based on what could happen. We want to make our decisions based on what usually happens. And what usually happens is when this happens, when we turn around and trade down to the other side of the channel, especially if we pass through the standard VWAP, the darker colored line, that is usually where, when we cross through that volume weighted average price after switching over to the other side of the channel, that's usually where the stock is going to keep going in the other direction for some time, and most likely will cause you to lose more money than you would have if you'd exited the trade earlier. Now, there's also some considerations we have to make about the price of what we bought. If we buy a call option, for example, during this trade, and we pay, I'm just throwing out a number here, $1 per share for each option. If I'm paying $1 per share for each option, in this particular case, if the option's value drops from $1 down to 70 cents, that's where I would say you should cut a loss because that's a 30% decline in the value of your option. Now, again, is it possible that the stock will turn around and move the options price back up? Of course, but we don't want to make the decision based on what's possible. We want to make the decision what's probable. And what's probable is if you've already seen your options decline to a loss of 30% of their value, there's a good chance you might see them decline even more. So, in short, if we are in a trade and even if we're winning or losing, whatever the case, once we see these bars cross over to the other side of that channel, that's already a reason to get out. So at that point, even if we're not down, the maximum amount we could lose, which I would recommend is 30% of your options premium. Even if we're not down that much, I would still recommend to exit because most likely in this case we'll be down that amount pretty soon. And if we are down 30% of our premium even before this happens, we still also would need to take action and exit the trade. So cutting a loss needs to be consistent, it needs to be routine. Obviously, when you look at your individual trades, you may find that it's better for you to cut your losses at an amount smaller than 20%, or smaller than 30%, let's say it's 20%. And maybe on the other end, you might need to cut your losses slightly larger than 30% based on your outcomes. But a good starting point would be to cut your losses if you're down about 30% of your premium. And then if you notice after time that your results dictate that you can risk a little bit more or a little bit less, then by all means do so. So I hope that helps, folks.